Welcome back to the What's More podcast. I'm your host, Quinton Harris. You're dialed into episode 177, and it's been Jobs Week here. And this is real important to us because this is what we've been talking about. This is what Daniel Halverson and myself have been kind of discussing in the form of when the rate cut's coming. When are you going to start seeing lower mortgage interest rates? And this is the sign we needed to see. And Jobs Week is a big week because we get two reports that come out on the job front. We get the private report, the ADP private report, and then we get the BLS report. And traditionally speaking, these numbers have not been correlating. Now, last month, we finally got some correlation and it worked out. And then this month, we got some more correlation and it worked out, meaning both of those are kind of trending the right direction as far as together and not polar opposites. And what we look at in this is we say, hey, listen, on ADPs in the private sector, did it come in at expectations or was it lower? Lower in this case means less jobs created. That means that the Federal Reserve is getting their dual mandate and they're starting to see a softening of the labor market. And then on the BLS front, again, did it meet expectations or did it beat it? And just for the record, this BLS jobs report, as you've heard me refer to as a BS jobs report a couple of times, has not really been in line because you get a number and then next month they go back and they revise it. And we got another revision on this one from the previous month. And if you take that revision and actually add in the jobs created, it's a negative job loss. And so what's interesting about this is these numbers really aren't accurate. That's what I'm getting at here. But we play the game nonetheless, and we want to see what it looks like. The more important thing we look at on Jobs Week is going to be the household survey. That helps determine the unemployment rate. And that unemployment rate went up again this month from 4.0 to 4.1. Now, the reason I'm going to lead with that is because in many of our podcasts here, we've been talking about the mindset of the Federal Reserve, like trying to get into the psychology of what are these guys thinking, what's going through their mind. And, I mentioned a couple of times, we sat down with one of the voting members in a fireside chat, and he was adamantly clear. Listen, we're going to have one rate cut. It's probably going to be in September. The only thing that could cause us to pivot would be if the unemployment starts to go up. We are concerned, and we're concerned to the tune that we would pivot necessary if that number goes up. Well, it did. It went up again. This is 3 months in a row, by the way, it's gone up. And you've heard me talk about it. The thing about unemployment is it can be a runaway train before you know it. And that is exactly what we're looking at here. So I'm going to pull this graph up here. Charlie will put it in our YouTube channel at What's Your One More with the number one. But this graph I'm going to pull up, what's interesting about this is it shows the 19 Fed members, right? And in the side of this, it shows in this graph that 17 of those 19 Fed members, they said, hey, listen, if this thing gets to 4.1, we're worried. And in this graph, you're going to see exactly where where you can say their threshold is of what they're thinking. And it's interesting because we're at that number now. So they were worried at 4.1. 4.2 is a danger zone. But 4.1, they're like, we're going to need to make some moves. We're going to need to pivot on here. And it's interesting to see their thought processes on this because that is where we are right now. And it appears that it's continuing to trickle this way, and it appears that we are on the brink of what we've been asking to see from the Federal Reserve, which is a rate cut. And, they come into July, right? It's a blank canvas here going into next week because you're going to get CPI. You're going to get the consumer's form of inflation. That's going to come out. Blank canvas doesn't mean we're going to get a lower reading. Doesn't mean we're going to get a higher reading. I don't know. But what I do know is that is going to come out in the same time, which the Federal Reserve will be meeting coming up here in this month. Do we get the cut in July or do we get it in September? I think once you see a number like came out today, I think you're going to have to kind of raise the percentage of that rate cut could happen. One of the more disturbing things in this job report is because you see the headline, right? It beat estimates, right? This is one of those things where you have to zoom in and then zoom out and take a look at the big picture. The headline is, hey, listen, job reports did great. But when you really dial in and look at this job reports, some of the things I wanted to point out on here that I don't think necessarily point to a strengthening in the job market or a strengthening in the labor market. First thing that jumped off to me was this. We're producing more part-time jobs than we are full-time jobs. Again, not only in the month of June, but if you look at Q2, we actually lost 300,000 full-time jobs and gained 336,000 part-time jobs. That's not a healthy job market, and that's not a healthy economy either. And in the month of June, we lost 28,000 full-time jobs, and we brought on 50,000 part-time jobs. That's the first thing that jumps off to me on this when I see those numbers, because I look at that and I go, that's not nobody wants a part-time job. Nobody wants they want a full-time job, right? No one's wanting to take a part-time job in place of a full-time job. So when you look at that, that's one of the things that jumps off the page to me. The other thing is this, as I look at these numbers that we're digesting and breaking down here. If you look at the revisions, we get the May number and then we get the revisions for April that come in. If you look at these revisions, the revisions over the last 2 months equal 111,000 falsely reported. Like they had to revise. Okay, that wasn't right. Let's take that back. 111,000 misreported jobs up there with this revision. That's not that. Those wipe out the positives that they're gaining during these times. And so you're actually going backwards instead of forward on this. And then if you look at the jobs that created the most jobs in the report, in this BLS report specifically, government put up 70,000. Healthcare did just shy of 49,000, and then education was 33,000. But there's always that notion that how many jobs is the government really creating? Like 70,000 jobs on here, and then are they high-paying jobs? Are they lower-paying jobs? So it's always, whenever you see the leader of the job market as being the government on there, that's where you start getting the speculation about, okay, are these real numbers? Like, what's going on here? So on the BLS job front here on the household survey. So we kind of talked about how they come up with the unemployment number on here. But for our audience that haven't heard that, I want to kind of break that down. On this survey, what they do is they look at how many people took on new jobs, like how many jobs did you take on, and then did you lose a job, right? And then they look at the total labor force and the increase of that month, and then they basically give it a metric, and that goes into it. So going from 4.0 to 4.1, the difference there is that the total labor force increased 277,000. So that means the labor force increased that, but there was only 116,000 jobs created. So when you do that math on there, that takes you from 4% to 4.1 on this unemployment. And keep in mind, that's the highest unemployment we've seen since November of 21. I think that that's important and worth stating as well, because that in itself is roughly under 3 years ago that we haven't seen this type of unemployment. So the Federal Reserve during this mandate has been saying, hey, listen, we're going to get inflation all the way down to 2, but we're not going to wreck the labor market. We're not going to wreck the jobs market. And what you're starting to see is all the areas that they've hit, and they've said, listen, if it gets to this level, we will pivot. We're at that level. I mean, we're at 4.1 right now, and this just came out Friday morning, and here we are on Monday morning talking about this, and the time has come. And so I personally think this is exactly why you're going to see the forecast for that rate cut go up dramatically in July versus lingering in September. If you get another bad jobs report in the month of August, there's a high chance, and in September, if this unemployment rate keeps going up, you'll see another rate cut come in September. And there is this argument that we've hit an important metric in the labor market. And that argument is defined as, when you see the types of dips and rises in the unemployment number that we've seen, there's this suggestion that you're kind of in a recession. You just don't know it yet. And that's kind of how recessions work, because sometimes you don't know you were in one till you get out of one. But in this particular case, the metric point that was hit on this has been a very, very pivotal telltale sign of, hey, you're probably fighting through a recession right now. And we just hit it with this number. So I think that that's interesting. For those of you who kind of follow like the 210 Treasury curve, the yield on that, the inverted yield, it's a very similar type metric. And it has also been inverted for quite some time, meaning that the short-term 2-year Treasury is greater than the long-term 10-year Treasury. That is another recessionary warning flag, and that's been inverted for some time, and it has been right over history. It's really over the last 60 years, it's been correct. So we have two basically warning signs that are coming out now. And I think the Federal Reserve is going to look at that. And I think there is a much greater chance now that you see this come online. I would say prior to this report, now, there could be a CPI report that comes out next week and all bets are off, right? So if the CPI comes out next week and all of a sudden it's much higher than expected, okay, there won't be a rate cut. But if that CPI comes in and it's either in line or below, I think the jobs report is what's causing kind of the momentum, if you may. And I think the thing about this that's important is that we are not celebrating anyone losing their job or the lack of jobs being created. We know it's tough. We see the comments on our YouTube channel at What's Your One More when you guys put those on there. You talk to us about those things. We appreciate that. We see this. We know what's going on out there. But it hasn't been showing up in the numbers until now. And that's not like exciting again. It's just that knowing what we know is now showing up as important. It's crazy it's taken this long for it to happen. And again, if you go back to the initial jobs claims that come out every Thursday, that's where people go to the unemployment line and they file for unemployment. There's a continuing claim number that's right behind that as well. So you have the weekly claim and then the continuing claim. The continuing claim number has gotten very high now, over 1.8 million. And now that you're seeing that kind of number show up, it's starting to echo sentiments of, okay, maybe the labor market has softened enough. Maybe we are at that pain threshold that the Federal Reserve voting members are concerned about. And just maybe we went from a 10% chance of a rate cut to a 50% chance here in July, or maybe we're even at 75. It depends on what side of the coin you're on there. But I think a labor report such as what we got here was a big, big deal. And I think it's going to continue to add basically pressure, and it's mounting for the Federal Reserve to make that initial cut. And, and Daniel said it best when he was on the show the other day. He's like, hey, a quarter rate cut's not going to do anything. As a matter of fact, I don't think it was Daniel. I think he was actually echoing what Jerome Powell said. A quarter rate's not going to do anything. And he's right about that. It's not. So then the question becomes, does Does 2 rate cuts do something? Is it larger than a quarter? There's a lot of speculation that's going to happen, especially, I'll continue to say, if that CPI report next week comes in low or right at expectation, the pressure will continue to mount. And I think we're going to start to see it kind of run its course. I think the rate is going to get cut. And I think this job report was the exact momentum that we needed. And I think the warning sign is the major flag of 4.1 unemployment on there. Again, all voting members of the Federal Reserve were surveyed, and 17 of the 19 said that's a number that's scary to them and that they think we need to do something. So we also, in this most recent meeting, Federal Reserve, we have a board member that's being replaced, a voting board member that's being replaced. And she's being replaced by Beth Hammock, who we don't know if she's going to be a dovish Fed member or a hawkish, but what we do know is this. She spent significant time in her career at Goldman Sachs, and so she's bringing some real world, mentality to the table at the Federal Reserve, which I think we need. We've talked about how the Fed members, many of them have not worked outside of the Fed or outside of education. It's great seeing real world experience make its way into that room because it is needed. However, she cannot vote till September. So replacing Loretta Master during this July voting cycle, because remember, she's out and Beth Hammock will not be able to vote until September, is going to be Goolsbee. And we know Goolsbee is traditionally a dovish member. So in the July vote, the person that's coming in and replacing the current voting members vote, you're going from a very hawkish mindset vote. Hawkish meaning, hey, listen, rate hikes. You're replacing it with a very dovish mindset, which means rate cuts. I think that's key too. I think that could also be another voice in the room as to a rate cut in July as we see what's coming here. So we'll anxiously await. But between now and then, we got a couple more reports that are going to come out that'll kind of deviate that thought process and where we go. But again, CPI comes out this week. It'll be interesting to see what that does here on Wednesday or Thursday this week. I'm not sure, but it's one of those days I have to double check. And then we'll kind of get our idea of what this landscape is going to look like for the week. So, guys, on our next episode, tune in because I'm going to share with you guys a bunch of things to debunk the 2008 group out there and the doom and gloom guys about real estate. We took a lot of your comments that you guys put on our YouTube channel, put a lot of work in the background here, and we're actually going to break down exactly what 2008 looked like versus right now for all those people and answer all your questions on the next episode at What's Your One More. If you like what you're hearing, please share this podcast. Please 5-star review us on Apple, on Spotify. And obviously, you've heard me say it a couple times, go subscribe to our channel at YouTube at What's Your One More with the number 1. You'll get all of our graphs. You'll get all of our metrics. Everything is in the show notes. Charlie does a great job producing that thing up. And again, appreciate all the comments and feedbacks on each episode. Guys, we'll see you at the next episode at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.